Today, unlimited quantitative easing, the DFA daily to the 24th of March 2020. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. There is really just so much going on that it's quite hard to keep up. But I'll try and guide you through some of the most significant issues that have been announced today. And we're going to start in the US, where the stock markets overnight performed pretty badly. And it's partly because the funding arrangements, which could be as high as $4 trillion is still being discussed. But according to The Hill, the Senate is on the cusp of a stimulus deal after agreements in key areas. And they say that the Democratic senators participated in the briefing call on Monday night on the latest developments in negotiations, and a vote is expected as soon as Tuesday. In a key concession to the administration, Democrats have agreed to a $25 billion grant to US airlines and a $4 billion grant for cargo air carriers, according to excerpts from the deal. Republicans want to limit executive compensation based on 2019 earnings, which was a lucrative year for corporate America, while Democrats want the limit based on a multiple of median worker salaries. In a significant concession to Democrats, the emerging deal would provide bumped-up unemployment benefits for 4 months, a substantial increase over the 3 months of augmented unemployment benefits proposed by Republican negotiators, according to a person familiar with the briefing call. Republicans have also agreed to provide $100 billion in funding for hospitals, $25 billion more than the proposal drafted in recent days by Republicans on an emergency supplemental spending package. The emerging deal would also provide $30 billion for care of people who fall ill. And the bill is also expected to provide $200 billion for various domestic priorities. Republicans scored a major victory by securing at least $500 billion for the Treasury Department to authorize more than $4 trillion in liquidity to distressed industries, which could provide a major boost to corporate balance sheets and financial markets. The money would be leveraged at a ratio of 10 to 1, giving the Fed broad ability to make loans. Aside from finalising language on stock buybacks and executive compensation, a few other issues will also need to be resolved. And also, according to The Hill, the House Democrats are proposing cash payments of $1,500 per person. The proposal would provide payments of $1,500 per adult and $1,500 per child in a household up to 3 children. The maximum family could receive would be $7,500. Individuals with income of more than $75,000 and married couples with incomes of more than $150,000 would have to repay some or all of the payment amount when they file their tax returns, but could choose to repay the amount over the course of 3 years. The IRS and Social Security Administration would work together to get the payments to households, and when possible, the payments would be delivered to people via direct deposit, according to a fact sheet. And the overall bill is now likely to be close to 1,400 pages as the two sides continue to try and hammer out a deal. And I guess meantime, Wall Street waits and watches. And talking of Wall Street watching, the other area to watch is the Federal Reserve. They made an astonishing announcement on Monday. And as Bloomberg reported, the Fed will unleash unprecedented measures to shore up the economy. The Federal Reserve unveiled a sweeping series of measures that pushed the 106-year-old central bank deeper into uncharted territory. In a surprise announcement on Monday before markets opened in New York, the US Central Bank said it would buy unlimited amounts of Treasury bonds and mortgage-backed securities to keep borrowing costs at rock-bottom levels and to help ensure chaotic markets function properly. It also set up programs to ensure credit flows to corporations as well as states and local governments. The Fed's latest step landed as investors wait for US lawmakers to deliver the multi-trillion-dollar package of support which we just discussed. Following a string of emergency measures last week, the moves also increasingly push the central bank into new territory by providing direct support to US employers, municipalities and households, which would traditionally be viewed as fiscal policy. And it's worth just reflecting on this chart, which shows that the volatility for US Treasuries has been the biggest since the financial crisis, and that tells you something about the quantum of the issues that we're facing internationally as well as in the US. And now, as Bloomberg reported, the Fed's move failed to spark anything beyond a brief rally in stocks and corporate bonds on Monday after weeks of staggering losses. Stocks fell 4.5% in New York. Yields on 10-year US Treasuries initially sank below 0.69 as investors digested the news before pushing back to around 0.74%. Some pockets of the markets reacted relatively positively to the Fed moves, and signs of stress in the corporate debt sector eased. Monday's Fed action follows an already dizzying number of steps taken by Chairman Jerome Powell in the past 3 weeks that would have been unthinkable just months ago. They represent a dramatic reaction to the sudden stop inflicted on the economy. The group of 20 finance ministers and central bank chiefs separately joined an emergency call to work on a joint response to the economic blow dealt by the health issues. And the US economy is reeling as cases rise and the death toll mounts. The Federal Reserve Bank of St. Louis President James Bullard predicted that the US unemployment rate might hit 30% in the second quarter, along with a 50% drop in gross domestic product. Morgan Stanley expects the US economy to plummet 30% in the second quarter. The package included several unprecedented steps for the Fed, including intervention in the corporate bond market, purchases of commercial asset-backed mortgages and exchange-traded funds, and, if Congress clears the way, a significant Main Street lending program directly aimed at aiding small businesses. This is not a slush fund, US Treasury Secretary Stephen Mnuchin told Fox Business earlier on Monday. It's a mechanism that we can use working with the Federal Reserve to provide another $4 trillion of liquidity into the market. That's on top of the Fed's balance sheet. This is a massive liquidity program. Beyond the unlimited quantitative easing program, the new emergency facilities will employ a total of $300 billion backed by $30 billion from the Treasury's Exchange Stabilisation Fund. The draft of an economic aid bill currently being hashed out on Capitol Hill includes $425 billion for the ESF to support the Fed's actions, and the Fed's new credit facilities carries limits on paying dividends and making stock buybacks for firms that defer interest payments but have no explicit restrictions preventing beneficiaries from laying off workers. And the Fed had already said a week ago it would buy at least $500 billion of treasuries and $200 billion of agency mortgage-backed securities. The Fed will now make those purchases unlimited and will take on a slew of new efforts, many aimed at directly aiding employers and households as well as cities and states. And there were two more programs which were created to support large employers: a primary market corporate credit facility for new bond and loan issuance, and a secondary market corporate credit facility to provide liquidity for outstanding corporate bonds. And yet another program, a term asset-backed securities loan facility, will enable the issuance of asset-backed securities backed by student loans, auto loans, credit card loans, loans guaranteed by the Small Business Administration, and certain other assets. And the central bank will also expand the existing money market mutual fund liquidity facility to include a wider range of securities, including municipal variable rate demand notes. And finally, the Fed said that it would expand the existing commercial paper funding facility to also include high-quality municipal debt, another move to help crash-strapped states and cities. The Fed's latest moves signal a resounding whatever-it-takes approach from the central bank and dispels any notion that monetary policy makers are either sparing ammunition or running out of unconventional tools, Bloomberg wrote. And as we discussed yesterday, the question is, how far do you go? And a lot of the funding is going directly to the business sector, who of course had all of the gains from the recent stock run-ups. So in a way, this further pivots the economy towards the big end of town and away from average punters. Now you can read more about the details of what the Fed announced on the DFA blog. I've put up there quite an extensive set of information relating to the initiatives. And to underscore the fact, the Federal Reserve says it's committed to using its full range of tools to support households, businesses and the US economy overall in this challenging time. While great uncertainty remains, it has become clear that our economy will face severe disruptions. Aggressive efforts must be taken across the public and private sectors to limit the losses to jobs and incomes and to promote a swift recovery once the disruptions abate. And pause for thought there, because of course no one quite knows whether this is going to be a very short-term thing or a longer-term thing. How long are we going to hit the pause button? Well, that's unknowable at the moment. So this state could go for a long, long time. And reflecting that level of uncertainty, the IMF warned of a potential global recession. That followed a conference call of G20 finance ministers and central bank governors on Monday. The human costs, they say, are already immeasurable and all countries need to work together to protect people and limit the economic damage. This is a moment of solidarity, which was a major theme of the meeting today. And the IMF highlighted 3 points. First, the outlook for the global growth is negative. A recession, at least as bad as during the global financial crisis or worse, is expected. But they do expect a recovery in 2021, and that, of course, is all going to be determined. And that, of course, will depend on finding a solution to the current health issues. The economic impact will be severe, but the quicker a solution can be found, the stronger the recovery will be. And the second point they made was that advanced economies are generally in a better position to respond to the crisis. But many emerging markets and low-income countries face significant challenges. They are badly affected by outward capital flows, and domestic activity will be severely impacted as countries respond. The investors have already removed around $83 billion from emerging markets since the beginning of the crisis, and that's the largest capital outflow ever recorded. And third, the IMF says that they will massively step up emergency finance. Nearly 80 countries are requesting help, and we are working closely with other international financial institutions to provide a strong coordinated response. They said we stand ready to deploy all our $1 trillion lending capacity. And we're looking to other available options. Several low and middle income countries have asked the IMF to make an SDR, special drawing right allocation, as we did during the global financial crisis, and we're exploring this option with our membership. Major central banks have initiated bilateral swap lines with emerging market countries. As a global liquidity crunch takes hold, we need members to provide additional swap lines. Again, we will be exploring with our executive board and membership a possible proposal that would help facilitate a broader network of swap lines, including through an IMF swap-type facility. And they concluded, these are extraordinary circumstances. Many countries are already taking unprecedented measures, and we at the IMF, working with our member countries, will do the same. Let's stand together through this emergency to support all people across the world. And talking of working together, the ACCC has granted interim authorisation in Australia for supermarkets to work together to ensure grocery supply. Supermarket operators will be able to coordinate immediately to ensure consumers have reliable and fair access to groceries during the current emergency. The interim authorisation will allow supermarkets to coordinate with each other when working with manufacturers, suppliers and transport and logistics providers. The purpose of this is to ensure the supply and the fair and equitable distribution of fresh food, groceries and other household items to Australian consumers, including those who are vulnerable or live in rural and remote areas. The authorisation allows a range of coordinated activities but does not allow supermarkets to agree on retail prices for products. So it'll be really interesting to see whether that makes much difference to the disrupted supply of goods going into the supermarket chain at the moment. Certainly, many people have written to me saying it's a major issue. And next, I wrote a post which I titled Economists' Reality? Reality Economists. Because so it seems some are beginning to wake up to the realities. And as I wrote, so it starts, the latest musings from Australia's army of economists are beginning to wake up to the grim reality. Reality is not friendly, and the news will likely get worse ahead. First, Westpac says that the unemployment rate is set to reach 11% by June. The economy is now expected to contract by 3.5% in the June quarter, and a sustained recovery is not expected until the fourth quarter. Just last week, they forecast a peak in the unemployment rate of 7%. Since then, we got more extensive shutdowns than originally envisaged. Economic disruptions are set to be larger as the government moves to address the enormous health challenge which the nation now faces. They say that historically recessions have tended to emanate from investment cycles, particularly those centred on property and building, with the initial shock centred on construction. As this recession will hit services much harder, the loss in jobs will be much quicker, but so too can the rebound. It all depends on how many firms remain solvent. In usual recessions, it is often uncertain whether the economy is in recovery phase, whereas the signals around government policy, particularly shutdowns, will be much clearer, and so households and businesses will respond. Their latest forecasts are based on an assessment of the expected impact of the package on jobs and growth. The two stimulus packages cost a total of $25.8 billion in 2018-19 and $36.3 billion in 2021. Of that total, $62 billion, $22.85 billion is allocated to direct payments to the unemployed and social security benefits, while $31.9 billion is set aside for small businesses and to retain workers. However, small businesses only receive cash if they retain workers, and the subsidy, keeping cash, which is withheld from workers for PAYE tax, is only, say, 20 to 30% of the direct costs of the worker. Given the current hugely challenging outlook for businesses, the package will be measured in terms of a success in keeping people in work. In other words, Westpac says a recession is pretty certain. And AMP's Shane Oliver said auction clearance rates and sales momentum are showing some signs of slowing this month. This may reflect an increasing desire on the part of buyers and sellers to put property transactions on hold. Social distancing policies will only intensify this. On its own, this may crash transactions, but may just flatten price gains. However, it's the likely recession that we've now entered due to related shutdowns that imposes the big risk. We expect at least 2 negative quarters of GDP growth in the March and June quarters, with the risk that the September quarter will also be negative. And the contraction could be deep because big chunks of the economy will be largely shut. Tourism, travel, entertainment, with a severe flow on to parts of retailing. The toilet paper, sanitizer and canned frozen food boom may help supermarkets for a while, but as Deutsche Bank recently calculated, for every dollar spent on such items, there is a $15 spent on things that are vulnerable to social distancing. Past large share market falls have seen a mixed impact on property prices. The 1987 50% share market crash actually boosted home prices as investors switched from shares to property. But the key is what happens to unemployment, as this often forces sales and crimps demand. Back in 1987, the economy remained strong and unemployment fell, but the recession of the early 1980s and early 1990s saw falls in average national capital city prices of 8.7% and 6.2% respectively as unemployment rose. The GFC share market fell 55%, saw home prices fall 8.7%, even though it wasn't a recession because unemployment rose from 4% to nearly 6%. If the recession turns out to be long, pushing unemployment to say 10% or more, then this risks tripping up the underlying vulnerability of the Australian housing market, flowing from high household debt levels and big house prices. The surge in prices, relative incomes and rents over the past 2 decades have gone hand in hand with a surge in household debt relative to income that was taken Australia from the low end of OECD countries to the high end. And so he says, we have always concluded that the combination of high prices and debt on their own won't trigger a major crash in prices unless there are much higher interest rates or a recession. Unfortunately, we're now facing down the barrel of the latter. A sharp rise in unemployment to say 10% or beyond risks resulting in a spike in debt servicing problems, forced sales, and sharply falling prices. This could then feed back to weaken the broader economy as falling home prices leads to less spending and a further rise in unemployment and more defaults and so on. This scenario could see prices fall 20% or so. Bear in mind, though, that part of this would just be a reversal of the 9% bounce in average capital city prices seen since mid-year last year. It also is not their base case. And Goldman Sachs was actually relatively sanguine. Goldman Sachs says it is now forecasting a 6% contraction in the domestic economy in 2020, the biggest since Great Depression, with unemployment peaking at 8.5%. On the upside, the strength of Australian bank balance sheets in terms of funding, liquidity and capital left them significantly less vulnerable than compared to any point in the recent past. Similarly, the source of historic loan losses for banks' corporate balance sheets entered this downturn in a better condition than at any point in the last 40 years, with close to an all-time low level of gearing and all-time low debt servicing ratios, Goldman said. But given the scale of the forecast contraction, bagged debts were now expected to rise significantly to 50 basis points of loans and slash bank earnings by 20%. A hard landing scenario would wipe out between 50 and 70% of the sector's earnings. So you can conclude from that economists are beginning to wake up to just how serious this whole situation is. And as I said in my post last Tuesday, the live show, fundamentally it's all about unemployment. If unemployment does go up, and if the government support levels remain relatively low, then many people are going to get into financial difficulty. However, if we get more support direct for households, there is a chance that the falls on home prices will be significantly less. At the moment, we haven't seen any evidence of that, nothing like the UK initiatives, nor indeed what the US are talking about. So I think there is a case for a more immediate action to support households. And if that were to come through, then maybe house prices won't fall as much as my 40% scenario, which frankly is still my base case. And in that scenario, unemployment would move up very significantly. And finally, talking of support for households and businesses, the Reserve Bank in New Zealand actually is leading the way again, I think. The New Zealand government, retail banks and the Reserve Bank are today announcing a major financial support package for homeowners and businesses. The package will include 6 months principal and interest payments, holiday for mortgage holders and SME customers whose incomes have been affected. The government and the banks will implement a $6.25 billion business finance guarantee scheme for small and medium-sized businesses to protect jobs and support the economy through this unprecedented time. We're acting quickly to get these schemes in place to cushion the impact on New Zealanders and businesses from this global situation, Finance Minister Grant Robertson said. These actions between the government, banks and the Reserve Bank Shows how we're all uniting, and we'll get through this if we all continue to work together. A 6-month mortgage holiday for people whose incomes have been affected means people won't lose their homes as a result of the economic disruption. The specific details of this initiative are being finalised and agreed urgently, and banks will make these public in the coming days. The Reserve Bank has agreed to help banks put this in place with appropriate capital rules. In addition, it's been decided to reduce banks' core funding ratios from 75% to 50%, further helping banks to make credit available. And we're announcing this now to give people and businesses the certainty that we're doing what we can to cushion the blow. The Business Finance Guarantee Scheme will provide short-term credit to cushion the financial distress on solvent small and medium-sized firms, and this scheme leverages the Crown's financial strength, allowing banks to lend to ease the financial stress on solvent firms. The scheme will include a limit of $500,000 per loan and will apply to firms with a turnover of between $250,000 and $80 million per annum. The loans will be for a maximum of 3 years and expected to be provided by the banks at competitive, transparent rates. The government will carry 80% of the credit risk, with the other 20% to be carried by the banks. And the Reserve Bank Governor Adrian Orr said banks remain well capitalised and liquid. They also remain highly connected to Australia's business sector and almost every household in New Zealand. Their ability to extend credit to firms to bridge the difficult times is critical and made more possible with today's announcements. We will monitor the bank's behaviour over coming months to assess the effectiveness of the risk-sharing scheme. And the government, the Reserve Bank and the Treasury continue to work on further tailor-made support for large, more complex businesses, Grant Robertson said. So, at the end of that litany of support here, support there, support everywhere, the fact of the matter is you can see how this is playing out. Everybody is banking on the dip being short and relatively sharp, with businesses still surviving through it, although unemployment will rise and we'll probably have recessions. But, in a way that's academic, if in fact we can bounce back afterwards. But I want just to underscore that the longer this goes on, the more difficult it will be for businesses to survive. And as a result of that, because we don't know how long the emergency was going to last for, there is still massive uncertainty ahead. And that, in a way, explains why markets are tending to be extremely twitchy. And we'll just now quickly go there to look at markets before we finish this post. So the ASX 200 was up 4.17% today to 4,735. And the Financial Services Index was up 4.71% to 3,831. The real estate trusts were up 7.53% to 943.50. And the Volatility Index was up 14.25% to 41.95. Up, of course, means more risk, more uncertainty. The S&P ASX 200 futures is up 5.06% to 4,756. Amongst the banks, ANZ was up 5.32% to 14.85. The CBA was up 5.05% to $57. The NAB was up 3.75% to 14.40. And Westpac was up 2.91% to 14.51. The Bank of Queensland fell 3.09% to 4.70. Bendigo and Adelaide Bank fell 3.53% to 5.47. Suncorp lifted 3.84% to 8.11. And Macquarie Group was up 6.66 to 78.99. AMP fell 2.63% to 1.11. Genworth, the mortgage insurer, was up 3.64% to 1.43. And McGrath, the real estate agents, was at 16 cents. Yellow Brick Road was down 13.56% to 5.1 cents. And AFG, the mortgage aggregator, was up 5.26% to $1, while Mortgage Choice was up 3.7% to 56 cents. And CIMEC Group was up 4.29% to 21.90. The Aussie US dollar was up 2.31% to 59.57, and the Euro Aussie dollar was down 1.33% to 1.81. The 2-year bond was up 2.6% to 0.294, and the 10-year bond was up 1.71% to 0.919%. And I can see there the influence of the Reserve Bank in bashing the yield curve into shape. The Aussie dollar gold cross was up 2.15% to 2,636, and the Bitcoin Aussie cross was up 7.69% to 11,052. And just quickly including the Dow Jones, which was down 3.04 to 18,576 yesterday. The S&P 500 was down 2.93% to 2,237. The financials index was at 302.65, with Goldman Sachs, for example, down 2.49% to 134.97. And the volatility index was at 61.59. And looking at the S&P 500 futures, it's up 4.26% to 2,315. And the Nasdaq futures was up 4.01% to 7,270. So it looks to me as though there will be an up day on the US markets. But I guess it'll pivot again on what the Congress does with regard to that large package that we talked about. So we continue to see significant swings in markets. We're going to continue to see that. This is a sign of a bear market. There will be days when the prices go up and then they swing down again. And I continue to believe that the bottom is somewhat lower than where we currently are, but I guess we'll wait and see. Meanwhile, the real economy is just glazing over as more and more of it is shut down. Queensland is putting border controls in, and the speculation, of course, is that now more businesses will be forced to close. In the UK, they've pretty much now imposed a standstill, patrolled, by the way, by police, and some accusing the UK of becoming a police state. And one other point to make, in the US, there's quite a lot of chatter about starting to launch a digital currency. Now, this is partly because they are saying that notes may spread the virus, but I suspect it's also part of a longer-term plan to begin to migrate the economy into a more controllable digital form. We've discussed this in previous posts. And there is the old adage of never let a good crisis go to waste. So I would not be surprised to see more initiatives snuck through, as well as the removal of other commonly accepted practices and the limitation of some of our rights. This is, to me, a very worrying time. And I think on the other side, we may well look back and realise that the things that we took for granted before the crisis will have perhaps gone away forever. And by the way, in Australia, the cash ban did not get up before Parliament parked itself until August. So that gives us a little more breathing space with regard to the cash ban here. I'll be back tomorrow with the next update in this series of daily updates. But I do want to just acknowledge the number of people who've sent messages of support to me recently, specifically saying how much they felt that I was providing an important service to them. And indeed, many people have made positive decisions based on what we've been doing. So that's very good to hear. And I just want to assure you that I will continue to try and portray things as they are. We'll move the spin away as far as we can and focus on the facts. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.